Hi, I'm Mark Boyer.
I'm Jason Jacoby.
We're here with the Boyer Brief. Good to be with you this month. So March Madness, love it. College basketball is awesome. Dude, did you see the SC hit that three-pointer to beat UCLA?
Yes,
oh, that was
course.
Amazing.
It made my day.
As an SC guy, I'm like all excited about that. Love to see us beat UCLA. But March Madness, excited about that. It's very fun. Big news, always fun this time of year.
Big news, that's right, Mark. Yeah, so this month's big news, the $1.9 trillion stimulus package has just passed. Let's talk a little bit about that. So what we know, it's far from perfect, right? There's a lot of holes in it. We don't believe that it's going to help the American public as a whole, but a lot of Americans are going to be getting that $1,400 stimulus check. So let's talk about the effects of that, both near term and long term. What do you think? What do you think is going to happen with the spending?
Yeah, I think there's some additional stimulus for obviously with checks. Everybody getting $1,400. A lot of people $1,400 more. It's not enough. It'd be nice just to have the economy opened up, in our opinion.
Mm-hmm.
But there's to be some near-term boost. I mean, I think some of that money probably will go to the market, if even possibly Bitcoin. Who knows the way that thing's going? But the markets have been looking forward. A lot of this is already, in my opinion, baked into the cake.
Absolutely.
I mean, it's markets are always looking ahead. So I think we knew that was coming, and so not a big change there. Also. This debt finance fiscal support this year, it's kind of, the question is, what's it going to look like for inflation, right?
Yeah.
So that's, you're adding more money, we're printing, it's like,
absolutely.
What do you think about that?
Yeah, so we are still below 2% inflation, which is quite surprising with all of this debt financed fiscal stimulus we've seen, right? So I don't think that the near term rise in inflation will be a bad thing, like you said. Something we have to look at and see if it's going to be prolonged or just going to be more near term. But according to the recent CPI numbers that we've got here on paper, we don't see that being a prolonged period. So inflation might take a quick rise up, but don't see it, especially with the Fed, right, keeping interest rates low to be more accommodative, which could be.
There's a lot of question too. The inflation, if it's just a supply issue, that the reason there's a shortage is that. With the pandemic, there's been a decrease in supply. So you could even make that argument. We're still below 2%.
Yep.
And interest rates spiked up this last month. We're up, got to as high as 1.6%.
Mm-hmm.
We looked longer term that could, even this year we talked about it could get to as high as 1.75%.
Yep.
So that's a possibility, which always, with heavy bond portfolios can be a little bit of a drag on the principal value of a bond, but yet long term it's nice to have higher interest rates too. But we don't see them going crazy. I think that's going to be muted just because America seems to be the strongest economy, and yet a lot of international markets interest rates are very low, so it's hard to go too high on the interest rate piece.
Yeah, great points. Do you think with higher interest rates, a lot of people obviously think with higher rates means bad for the stock market? Well, history tells us over the last 40 years, it's actually not true. Even with rising interest rates, basically, just insinuates that people are spending money. Like you said, it could be a supply issue, supply demand. But what does that mean for the markets, specifically stocks, equities? Do you see the rest of this year being positive? Are you saying?
So interest rates, when they're going up, when the economy's hot, that's a good thing, right? It's actually not a bad thing when the economy's going high. So that's positive for companies. The cost of borrowing gets higher, which is a drag, but also, especially coming out of COVID, we see that there's going to be a lot of demand. So it's not a negative situation. And in fact, stocks over time, history has proven that stocks are one of the best outperformers of other investments during rising rates too.
Great.
So we see that could be cause volatility, but also long term still a great place to be. So
Great point.
Speaking of the markets, they've done well recently.
Yeah, year to date. So Dow Jones update from last month here. First quarter's almost done.
Yeah.
It's flown by. Dow Jones 7.1% as of today. NASDAQ 3.35%, and then S&P rounding it out. About 5%, 4.99, so touching right there. It's been a good quarter, obviously volatile.
Yeah.
Thoughts on markets? I know last month, what did you say?
Well, we said last month that we thought they were a little pricey, and that would either go sideways or down. Ironically, it was interesting because the NASDAQ, which has been the leader, actually intraday dropped in February 12.5% in an intraday, and then immediately bounced back up. So you could say that was its correction. We were waiting for a correction. NASDAQ happened, and now still NASDAQ struggling a little bit at its 50-day. The interesting thing is that the S&P and especially the Dow 30 have really taken off and hitting new highs. A lot of that's probably because of energy names in the Dow, specifically because energy and price of oil has gone up as we've seen at the gas pump. So that could be a reason there. But anyway, we feel like we were sort of right. We said it was going to go sideways or down, and we're still kind of in that role. We're still positive on the year, but interesting that there's a flip going on from growth stocks at the moment to looks like value, which we talked about too.
Absolutely. So kind of piggybacking off that, earnings, manufacturing data, we've had stronger than expected earnings. We talked about that in last month's newsletter. We're about to have the first quarter end here, so earnings obviously will be following that. Are we seeing, this is strong signs of growth, you think, for the rest of the year? Are we getting volatility here to stay? Thoughts on that?
Yeah, I think it's going to be volatile, but at the same time, then GDP looks to be really strong. Our estimates are anywhere from, low end 5%, plus 5, to some are saying as high as 8%. We're in that kind of 6 to 7% range. Feeling pretty good about that. So that's a massive GDP. Again, coming out of COVID out of the year, there's a lot of pent up demand as the economy begins to open up. Just feel like there's got a lot of opportunity for upside. A lot of that's baked in in the markets already, but still surprises to the upside will be positive for the market as well.
Absolutely. Last thing I want to cover here, just some updates on the COVID numbers. You talked about the economy reopening, right? Always a great thing. This last week, the U.S. reported 38,000 new COVID-19 cases on Sunday, down 8% week over week, which is great. So the cases are moderating. Right. It's what we want to see. Trends
going in the right
direction, like you said. 2/3 of adults over 65 have been fully vaccinated. It's only going to help us move forward to post-pandemic life. So, any closing thoughts or statements you want to make here for the next month till we see these guys again?
Yeah, I'm excited again. Thanks for your business. We feel very honored to work with you all, and we're excited about the future. Again, like I told you, a long-term game plan is important to have to stay the course, whether through thick and thin and volatility or whatever. We've got some volatility this week or this last month, and you guys have done a nice job with that. And so we might see some of that, but we're also very positive on the year. Feel like there's a lot of nice potential, future in the markets, upside to the market still this year. So excited about that, and excited to work with you all.
Yeah. Thanks so much, Mark. Thanks, everybody. And that's your month's Warrior Brief. We'll see you next month.